I just covered my short position in GME and I even went long. We're going to be discussing my positions in GME in this video and even discuss how the price action for today ended up going. Let's just look at the charts real quick. Let's get an idea of how things kind of went along. Nothing too crazy here, right? So we opened up a little bit of a gap up around 29 bucks or so. Actually, what was our close from the previous day? So we actually ended up opening up a little lower from Friday's close. And from that point on, after what? Yeah, right about when the shareholder meeting begins, 12:30 Eastern time, we start falling apart. We end up hitting the bottom here at about an hour later, and we bounced just a little bit off, and we finished the day at 25.14. So another down day for GME, 12.13% down on the day. Now, I've been short GME since last week. Was it last week? Maybe even the week before. Let me just bring it up here. So this is just my little, I've been keeping track of my positions here. I ended up shorting on June 11th. Now I did add onto the position last week. Again, I've covered my positions in my past couple of videos here. I've been short 3,000 shares. Originally it was 2,500 shares. Then last week I added 500 more shares. I kind of averaged out. So that's the real, average that I have on my short. And I ended up getting out of the short position today at $24 for just about almost $19,000 in profit. Now, as luck would have it, that was a limit order that I put, and we ended up triggering it right at the low candle of the day. This is the low candle here. Notice how we ripped right through 14, hit 23.79, and then we ended up coming right back up. So likely, anyone that had that as a stop, maybe they bought the low here, they ended up getting stopped out. People that had short positions, similar like myself, were looking for an exit in this region. You have to understand that when I'm short and I'm covering, I got to buy this share back, right? So I'm providing that buying support. So when we're seeing something like this happening, this could be people buying the dip, or this could be people like myself covering our short position, giving that lift back into the stock, at least for the time being. From that point on, that's when you're going to have the longs actually come in and start, bidding up the stock back up again. But yeah, I got lucky that I had a $24 exit there. I mean, I will show it also in my account. For starters, you'll see that my short position is no longer there. It was there in my previous video if you bring that up. If I go over here, we will see right here under trades at 127, right, at the price of $24, quantity of 3,000 shares. I got out of that trade, and there's my realized P&L, 18,000. Well, as I said, just under 19,000. If I go on the orders here, where is it? It should also be here, right? We could see right over there, right? 3,000 shares. Okay. Now you may also notice this order right about here for GME buy. This is me going long, 2,500 shares. Yep, I am long now as well at 24.71. That is where my long position is. I was waiting to see if we could maybe hold on to some sort of bounce. And I got in, where did I get in? Yeah, I got in during this lift off over here. In general, risk reward buying in this $23, $24 region looks good to me. One of the reasons why I wanted to get out, cover my short position around this area, is because I know a lot of people are going to be looking at Raw and Kitty's average, which is 23.41. They're going to see that as an anchor point. I covered that in my last video too, that they're going to see this as an anchor point. And then people might be buying their shorts, like myself, might be looking at a place to cover there because I might be thinking that buyers are going to be stepping in there. And, it kind of rang true here because we came within, 40 cents of it, right? And it might hold for the time being, which is why I like it as a risk and reward. If you look back at all my previous trades here, this is not the first time that I've been short the stock. I've been short the stock, May 15th. May 15th again, June 7, and June 11. Those are all the times I've been short. They've all been profitable for me, but if you were to add up all the gains from being long the stock, it's way higher than that. Actually, let me see. I did write down exactly. So far, just from shares, from being long shares, short shares of GME in the past, it's like 5 weeks now. Ever since Ron Kitty kind of entered the scene, I've locked in $195,268.90 in realized gains from just trading shares back and forth. I'm also going to show you guys, let me see here. So this data here only goes up to yesterday or the last trading day. It's not updated for the profits I've taken today on my shares. You might notice it says GME and also GS2C. That's in the Frankfurt Exchange. GME, I did trade that during one of the run-ups. If you were to add those numbers together, it would be like a little bit over 176, right? That's shown over here. And then plus the gains that I realized today brings it up to 195 in shares, you know? And now I'm long. Now I'm long the stock. What other changes have I done with my position here? We'll bring up my brokerage. We will look at my trades here again, and we will see that I ended up exiting out of this call position that I wrote. Yes, I wrote a naked call position, a $32 call position. Originally, it was set up as a straddle. If we go to Thinkorswim, I'll toggle it up. This is how it looked like going into the straddle itself, right? I sold the put, I sold the call at $32 strike price. I collected $20.54 of credit. Similarly, as price came down to that $24 region today, and I was looking at that call leg that I sold, it was only worth about $2.50 or so. If I bring up my P&L here, $2.42, okay? But I wrote that side for over $10. You know, so someone bought it for me for over $10, and I bought it back for $2.42. At that point, I'm like, I got over 75% of profit on the table. Let me just take it. I don't have to wait till June 12th, 3 more weeks, 4 more weeks, you know, to take the last 24%. Let me just take it off now. I can get some margin relief off it. Maybe I could even sell a call later down the line and capture even more premium. So I took that off. So I no longer have a straddle on. I'm just, you know, that put that I sold. If we click, the reason why I click over to this screen, by the way, sometimes is because I'm able to filter down by stock. So in this case, only GME. That way it's not cluttered up with like all the other positions that I have on the screen. So as we look, all I have is this $32 put as an option. Which, you know, you can see here, I wrote 10 of them, and I just have I have unrealized P&L of 562 on it, right? Nothing crazy. You can see that I wrote it for, you know, I sold it for $10, and it's currently worth, the last price was $9.75, you know? So it's actually pretty crazy to take a look at this. Even though GME was crushed today, the option itself only went up by 12%, okay? That's how much it sucks being an option buyer. And why is that? Well, likely volatility is just being crushed right now. The shareholder meeting was a catalyst no matter what, how you view it. Some people are like, oh, it's always going to be a nothing burger. It doesn't matter. Market makers are going to spike up that volatility, imply volatility in these options beforehand. And if nothing happens, or even if something happens, after the event, all that implied volatility gets sucked out. And in this case, I mean, a lot of it got sucked out. You know, so I still have, you know, a good bit to realize. I mean, if this option were to completely expire out of the money, I held it till expiration, I would be able to take about $9,500 of profit in addition to what I've taken. But I did end up taking just a little bit over $8,000 in realized profit from that call position. I also want to remind you guys, for those that haven't seen my previous video, I did have another put that I had written just maybe a week ago as well. About a week ago. You see, I wrote these June 21. It was a put spread that I wrote. I sold a 20 put, bought the 11 put. The reason why I did that is because when you're writing options for GME right now, you have to put up a lot of money when you're writing these naked options for them, simply because of the level of volatility, and these brokerages are requiring it. It's much easier for me to write naked options on Apple than it is for GME. So for me to get margin relief, when I say margin relief, meaning that it's not taking up that much margin in my account, if I simply buy a very cheap leg, you know, and the brokerage sees that my risk is limited to a specific level, so obviously my risk here is limited between $20 and $11, right? That's where I can lose my money. Much less margin is required from me, as opposed to them seeing that my risk is from $20 to $0 over the course of this option. But let's be honest here, the chances of GME having dropped, you know, from at this point, I forgot what it was. I think GME was trading at like $23, $24 when I wrote this. The chance of it going from $23 down to $0 over the course of like 1.5 weeks for max loss for me is probably nil, close to nil. But it doesn't matter. I still have to essentially have the money backed up, or the margin backed up for that type of position. But by buying the $11 put, I only have to cover this $9 gap. I give up a little bit of profits. As you can see, $300 is what it cost me. But at the same time, it gave me at least half, if not more, margin relief on the position. Now, with that, right, with that put that I also realized profits on, and the call that I realized profits on, I'm currently at $214,131.62 in realized profits on GME with shares and options. So that's pretty crazy, right? It just goes to show you, how much you can actually make by trading the range here, and being agnostic when it comes to what direction you're playing. You don't have to kind of pick your side and play it all the way out, And, I'm not exactly using crazy size out here, right? I mean, I bet some of you out there do have 1,000, 2,000 shares of GME in your accounts, right? That's what I'm playing around with, right? I'm not using 10, 15,000 shares where it's so easy to make 50 grand. I'm not really using that, right? I'm just taking advantage of these ranges that are occurring. Now, the last position that I have available to myself is this calendar spread. We've talked about this. It's not really moving so far. It's at $20,000 in profit. We're seeing a lot of volatility crush, especially happening on the back month, the June 25th, 2025 position. So that's kind of messing my P&L right now. We can take a look at it. This is how it currently looks like. So yes, we've seen volatility come out of my long leg, which is always going to end up constricting this P&L chart for me. If GME continues to trade, less volatile, I mean, today it was at 12% today, but again, the funny thing with GME is if it's going down, volatility ends up actually shrinking. At least that's how the market makers are pricing these options, So we'll see how this position works out. Currently, it's $20,000 in unrealized profits, so we still have some more potential to add to the pool of profits that we currently have. But okay, so what's my opinion, though, about how the shareholder meeting went today? Well, it was disappointing once again. They ended up postponing this meeting. The meeting itself was about 20 minutes long. It was very, very short. They really did not answer any questions whatsoever. Ryan Cohen did step out, but even his the remarks that he had prepared for himself, he could have given those exact statements a year ago, 2 years ago, honestly. They really didn't touch much on what the future looks like. For GameStop, he kind of touched more so on, the current economy, and that they have to, keep sizing down, to remain break even at the very least, if not profitable. So, I mean, and the price action kind of spoke for it. And what's interesting too, so I had a stream up of a YouTuber, and probably like 95% of the people that do watch him are bullish GameStop. They're not shorting GameStop, just based on how the comments usually are and so on. And I usually see this YouTuber, put out a poll there about what they think about GameStop today, about this news event, that news event, or this tweet. And no matter what, I've always seen a very, very positive bias on those polls, right? Where it's like 90% of people that are answering that poll are always choosing whatever is the positive answer for GameStop. What was interesting, though, today was when he polled the people and asked them what they thought of the shareholders meeting. These were the results. I apologize for it being kind of like cut out weirdly. He just had the poll also like positioned weirdly on his live stream. I'm sure some of you might even recognize this poll because you were in that live stream, but right, the question was it a positive meeting? Only 23% of people said yes, 22% said no, 38% said would like more info, and 17% no vote. Now, even though it shows that 22% of people said no, this number is way, way higher, because I guarantee that the people who said I wished we had more info kind of felt that it wasn't really positive, right? The ones that are true on positives, like, who think everything is great, are the ones who said yes. Anyone who's kind of upset said no. Anyone who's kind of upset but doesn't really want to, as people like to say, FUD their own bags, kind of said we want more information. And the people who said no vote, maybe they're split, maybe they're not, they're impartial to it. But this is the most split that I've seen a poll posted up. And this is a live stream that had thousands of viewers, like 2,000 viewers or so. So it's a lot of people that kind of put in the bet. So just based on this, I can see people were disappointed because we got very little guidance as to what the future looks like for GameStop. And the problem with that is, we do need momentum. If you're long the stock, you need momentum to get out of this range. I think this $23 to $30 range it might get very sticky for GameStop, and GameStop might end up being stuck here for the rest of the year. Unfortunately, Ron Kitty getting out of his options, going to his shares, kind of takes the wind out of the sails. And I've spoken about this in my previous video, right? A lot of people are like saying, like, so what now? Like, where's the gamma ramp? Where's the hype? What do we talk about? You know, GameStop's not giving people anything to talk about. Let's be honest here. It's not saying, listen, we're looking for a business that fits these metrics and so on. I mean, if you read some of the remarks that GameStop is basically saying, even from Ryan Cohen today, he made it seem as though like they're in no rush to be merging or buying a business, right? Because they want to make sure they get the best deal possible and the best use for their money. That almost sounds like, you know, there's really nothing on the table yet for them, or nothing to be shared. And if there's nothing coming from GameStop to hype up the company, and even Ryan Cohen said that in one of his last sentences, that the company does not want to just hype things up. So if there's no hype coming from the company, and if Ron Kitty is no longer kind of gambling of options on the stock, where does the momentum come from? I got in long simply because I like the risk and reward in this area. Plus, I still feel that this Friday coming up will have some sort of momentum behind it. You know, a lot of people did follow Ron Kitty. When he bought those options expiring this Friday, a lot of people kind of piggybacked on him. So we have a lot of option expiration going to this Friday. I can see there being a lot of volatility. Volatility is good. You can either make money quickly or lose money quickly in volatility, but I'd rather take that sort of environment as opposed to kind of price doing nothing. It wouldn't take much to get me out of this position too. You know, a move down to 22, slow bleed. I mean, it's going to be tough for me to muster staying into this position, right? Again, I'm not going to sit here, you know, my number one thing is to make money. That's what I care about. I don't care about being long the stock, short the stock. The money's green on both sides, believe it or not. And the money gets spent the same way on both sides. So I don't care what position I'm in. Currently, it's long. Obviously, I want the stock to go up. I think that's the easier pathway for the stock. But it may also go only up to 27, 28. And guess what? Maybe that's going to be my exit. Would I short it there? Probably not, to be honest, too. I think a short mid-20s, low 20s, not that attractive. That's my opinion. Something else I want to touch on, you know, on Reddit or even other YouTubers, I see so much, you know, people just hyping up random stuff. You know, people are hyping up, you know, Ron Kitty exercising his options, and that all of a sudden 4,000 shares handled by this market maker is going to erupt the markets, you know. And then Friday came about and nothing. The stock went down, and then people started saying, "Oh no, it's T+2, not T+1." Okay, Monday comes about, right? And now again, nothing. You know, the stock doesn't go up, it goes back down. Now people are trying to figure out a reason as to, you know, why they didn't blow up the market, you know? And then you got some other YouTubers out there that are taking all of Ron Kitty's memes out there and like trying to figure out the secret message, and they're even, you know, almost making it seem as though Ron Kitty was able to foresee things in the future and know the exact dates that Ryan Cohen was going to dilute things and when the stock was going to be up, and as though like Ron Kitty's some sort of like omnipresent, you know, as though he knows all this type of stuff. Again, and these are adult men that are just like going crazy with these theories out here. I mean, it's pretty simple. The stock goes up if people buying the hell out of the shares and people buying the hell out of the options. That's what it takes, okay? And truth be said, for that to happen, you got to have some hype in there. That's it. You got to have some catalyst. We've seen the stock go up like crazy because of Ron Kitty coming back. That was the hype. It might get a little bit overplayed. We've seen him tweet twice today, you know. Is that really going to bring the stock up anymore? Probably not, right? If Ron Kitty all of a sudden, you know, sold all his shares and went balls deep and bought options expiring next month of $200 million, yeah, that's going to bring a lot of hype back into the stock. But we need catalysts to get the stock moving again, you know? Not trying to decipher like what this meme that Ron Kitty uploaded, you know, that whether or not maybe on on fucking June 30th, the stock is going to explode because Ron Kitty was able to see into the future, you know, like come on. If you want to make money, you got to stay pragmatic. You got to look at what's in front of you. You got to look at the charts, you know. If the stock is bleeding, if the volume's depleting, it's likely not going to be a rebound there. You're likely not going to make money. I get some of you guys out there wish for MOAS. You want MOAS to happen, you know. And you've seen the stock price go up to 50, 60 bucks. You haven't sold because you want MOAS and you're losing out on those profits. If I look at my positions, you know, look at my exits on some of my long positions here. It's not to brag, but it's to show you, you know. Long at 18, exited at 62, right? That was the first run-up, massive run-up that I had. And then I had this long over here, which I exited out at $55. And I was average long of 29, right? So I've partaken in both of the big pumps. And I'm happy that I did. I'm happy that I did. And I've also shorted it, right? And now I'm long the stock again. You've got to stay open-minded to taking profits when you see these massive run-ups. And I'll tell you this much too. A lot of people do not touch on this. A big reason why GameStop was able to rally so hardcore back in 2021. And let me tell you this much too. I partook in that rally too. I was long from like $70 and I exited at $4.25, okay? And I remember that morning when the buy button was taken away from several brokerages, including Robinhood. I also felt robbed. When that happened, because I knew that, hey, the momentum was so powerful that yes, we could have probably gotten to $1,000. And the reason for that is because Wall Street was not expecting this level of movement and this level of involvement by retail investors. That's why it worked so well. Now, Wall Street is not blindsided by this. More importantly, market makers not blindsided by this. Market makers actually ended up underpricing the out-of-the-money options back in 2021. They didn't believe that it was possible for a stock of that size to move so quickly and for there to be so much open interest in these options that are so far away. That's what was catching them off guard. They had to delta hedge to levels that they never thought they would have to, because there was so much money coming into these options that was so far away, and then also so much money buying these shares. So what did the market makers do this time around, or ever since then? They've overpriced these options. They've made it so much more difficult for these sort of gamma ramps to occur, actually. Because if previously, let's say a person had $1,000 and they were able to buy options back in 2021, they could have bought X amount of them, out of the money options. Now, if they were to try to do that, they would maybe only grab a third of what they were able to do back then, only because market makers pumped the implied volatility across these options today. So when you're buying them today, you afford so much less than you could before, which makes retail's power so much less when it comes to buying these out of the money options and then trying to get the share price towards them and so on. So it's so much more harder to get that momentum going. You have to be cognizant of that, and the fact that, listen, if we wanted to see prices of thousands of dollars a share, the time to have done it was probably then, when nobody expected the stock to move the way it did. Now it's very tough because we've shown Wall Street what we're capable of. They've positioned themselves in a way. This is also many years past, so they have a lot of time to train themselves on that data. So it's really hard to even try to replicate that. I'm actually personally even surprised that we got to the levels that we've gotten. I've seen, we've seen prices of $80 in the pre-market during this round. That's what, 80 times 4, $320 GME based on past levels. That's impressive no matter what. But these are things to keep in mind when you're seeing these ramp ups occur. That sometimes it's better to walk away with some profits as opposed to seeing the price come all the way back to you again. And I think that's kind of all that I wanted to cover in this video. I'll keep you guys updated on these positions. If there's any massive new developments this week with the stock, I'll cover them. Hopefully we kind of, there's going to be a lot of messiness in this range here between this $25 to $28 range. It's going to be tough. It's going to be very, very muddy in this range. Muddy enough that I'm going to have to, think about how I want to play it. Do I just take whatever profits are on the table at that point? Or do I think there's a way to kind of break out? I personally do not see us breaking out above $30 unless we get another catalyst on the table. That's just how we see an actual catalyst, okay? Not some tinfoil DD, based on some meme or some conspiracy. Like an actual, press release type of catalyst. And that's all. That's all I wanted to say. If you enjoyed this video, throw me a thumbs up. Leave me a comment if you have any questions. Other than that, good luck out there and have a great day.